Most business owners think they're managing cash flow. They're actually watching it disappear. And by the time they realize it, $50,000 is already gone. Not spent, not invested, just gone. Today, we are breaking down the single most expensive cash flow mistake small business owners make. And more importantly, how to fix it before it costs you everything. Agitation. Plus identity. Let me ask you something. Have you ever looked at your bank account at the end of the month and thought, where did all the money go? You had revenue, you had sales, you even had profit on paper, but the cash, it vanished. This is not a revenue problem. This is not a sales problem. This is a cash flow structure problem. And it is silently destroying more small businesses than bad products, bad marketing, or bad timing combined. Here is the truth most entrepreneurs never hear. Revenue is vanity. Profit is sanity. But cash flow is reality. And if you do not control your cash flow structure, you do not control your business. You are just hoping. Framework intro, the mistake. The mistake is what I call the revenue expense trap. It works like this. Money comes in. You feel good. You pay bills. You cover payroll. Maybe you buy some equipment or run some ads. Then more money comes in. And you repeat the cycle. But here is what you are not doing. You are not separating your cash into buckets before you spend a single dollar. You are treating your business checking account like one big pile of money. And when everything lives in one pile, everything looks available. That is how $50,000 disappears without a trace. Not because someone stole it, because your structure allowed it to leak. The mechanics, how $50K vanishes, let me show you exactly how this happens with real numbers. Imagine your business generates $300,000 in annual revenue. Your profit margin is 20%. That means $60,000 in profit. Sounds healthy. But here is what actually happens month by month. January, you get a big client payment. $25,000 hits your account. You feel flush. You pay some overdue bills. You upgrade your software. You give your team a small bonus. February, revenue is slower. $15,000 comes in, but your expenses stayed the same. You dip into what was left from January. March, another strong month, $20,000. You invest in marketing. You buy new equipment. You feel confident. By June, you have spent $45,000 on things that felt necessary at the time. But none of it was planned. None of it was measured. And now a major client delays payment. Your payroll is due in 10 days. And your account balance? $3,000. That is the revenue expense trap. You had profit on paper, but you had no cash structure. And now you are scrambling. Curiosity loop, but here is what makes this mistake so dangerous. It does not feel like a mistake when it is happening. Every expense feels justified. Every purchase feels like growth. And that is exactly why most owners never see it coming. Until they do. And by then, the damage is done. So how do you fix this? You do not fix it by trying harder. You do not fix it by checking your bank account more often. You fix it by rebuilding your cash flow structure from the ground up. And I am going to show you exactly how to do that right now. The solution, 3-bucket cash structure. The solution is what I call the 3-bucket cash flow system. This is how smart owners stop cash from leaking and start building real financial control. Bucket number 1, operating cash. This is the money you need to run your business day to day. Payroll, rent, utilities, software, supplies. Everything required to keep the lights on. Here is the rule. Your operating account should always hold at least 2 months of operating expenses. Not 1 month, not when you get around to it. 2 months, minimum. If your monthly operating costs are $10,000, you keep $20,000 in this bucket. And you do not touch it for anything else. Not for growth, not for emergencies. This bucket has one job, survival. When you know 2 months of expenses are protected, you stop making desperate decisions. You stop panic hiring. You stop discounting just to chase quick cash. You operate from strength, not fear. Bucket number 2, growth capital. This is the money you intentionally set aside to invest back into your business. Marketing, equipment, new hires, expansion. But here is the critical difference. Growth capital is not whatever is left over at the end of the month. It is a planned percentage of every dollar that comes in. I recommend 15 to 20% of net revenue. Before you pay anything else, this percentage goes into the growth bucket. Why? Because if you wait until the end of the month to see what is left, there is never anything left. Operating expenses expand to fill whatever space you give them. This is called Parkinson's Law, and it will eat your growth budget every single time. By separating growth capital first, you force your business to operate within real constraints. And constraints breed creativity. You start asking better questions. Do we really need this? Can we negotiate this? Is there a smarter way? That is how you build discipline. Bucket number 3, owner's reserve. This is the money that pays you, not your business. You. Most owners pay themselves last. Whatever is left over, and most months, that means nothing, or scraps. The owner's reserve flips this. You decide your minimum monthly draw, let's say $4,000. That money gets transferred to your personal account on the first of every month, like a salary, non-negotiable. Why? Because if you cannot afford to pay yourself consistently, your business is not sustainable. It is a very expensive hobby, and when you pay yourself first, you also create a clear profit target. Your business must generate enough to cover operations, growth, and your income. If it cannot, you know exactly where the problem is. You do not guess. You see it in the numbers. Real example, the transformation. Let me show you what this looks like in practice. Sarah runs a consulting business. She generates $20,000 per month in revenue. Her operating expenses are $12,000. She was keeping everything in one account. Some months she paid herself $5,000. Some months $2,000. Some months nothing. She was constantly stressed. She never knew if she could afford to hire help. She felt stuck. We implemented the 3-bucket system. First, she calculated her true operating needs, $12,000 per month. She built her operating bucket to $24,000. That took 3 months of discipline. Then she set her owner's reserve at $4,000 per month, transferred automatically. Finally, she allocated 20% of remaining revenue to growth capital. That was $800 to $1,200 per month, depending on the month. Within 6 months, everything changed. She stopped checking her bank account every hour. She hired a virtual assistant because she could see the growth bucket growing. She paid herself consistently for the first time in 2 years. And when a client delayed a $20,000 payment by 60 days, she did not panic. Her operating bucket had her covered. That is what structure does. It turns chaos into calm, the psychology. Why this works, but here is the deeper reason this works. It is not about the math, it is about decision-making psychology. When all your money lives in one account, every dollar feels available for every decision. Your brain cannot distinguish between survival money and growth money. It all looks the same, but when you separate it into buckets, you create mental boundaries. You give each dollar a job before it even arrives. This is called pre-commitment, and it is one of the most powerful behavioral tools in finance. Studies show that people who pre-commit their money save more, invest more, and spend less impulsively. Not because they have more willpower, because they remove the decision from the moment of temptation. The 3-bucket system does exactly this for your business. It removes the daily decision of can I afford this, and replaces it with which bucket is this for? That one shift changes everything. Common objections plus rebuttals. Now I know what some of you are thinking. This sounds great, but I barely have enough cash to cover next month. How am I supposed to build 3 buckets? Here is the answer. You start with 1. If you cannot do all 3, start with the operating bucket. Calculate your true monthly operating expenses, not your wish list, your reality. Then save 1 month, just 1. Cut 1 unnecessary expense. Negotiate 1 supplier. Delay 1 purchase. Most businesses can find 5 to 10% savings in 30 days when they actually look. Once you have 1 month saved, build to 2. Then add the owner's reserve. Then add growth capital. This is not about perfection. It is about progression. Another objection I hear, my business is too small for this. I need flexibility. Flexibility is exactly what got you into the revenue expense trap. Structure creates freedom. The most flexible thing you can do is know exactly what you can afford. That is real flexibility, not financial confusion disguised as options. Advanced tip, the 48-hour rule. Here is an advanced layer that separates smart owners from everyone else. The 48-hour rule. Any expense over $500 that is not in your budget gets a 48-hour waiting period. No exceptions. Not because you are cheap, because you are strategic. In those 48 hours, you ask 3 questions. 1. Does this directly increase revenue or reduce long-term costs? 2. Can I achieve the same result for less money? 3. What happens if I do not spend this at all? You would be shocked how many urgent expenses disappear when you add this filter. I have seen business owners save $15,000 to $20,000 per year just from this one rule. Not by cutting everything, by cutting the wrong things. The impulse buys, the shiny objects, the everyone else is doing it investments. 48 hours gives your brain time to shift from emotional mode to analytical mode, and that shift is worth more than any single expense you cut. The warning: what happens if you ignore this? Let me be direct for a moment. If you do not fix your cash flow structure, here is what is coming. A slow season you did not expect, a client who pays 60 days late, an equipment failure that costs $8,000, a tax bill you forgot to save for. These are not rare events, they are normal business cycles. And when they hit a business with no cash structure, they become emergencies, then crises, then business failures. The Small Business Administration reports that 82% of business failures are caused by poor cash flow management. Not bad products, not bad teams, cash flow. And the tragic part? Most of those businesses were profitable on paper. They just had no structure, no buckets, no reserves. They were running on hope, and hope is not a strategy. The recap plus empowerment, so here is what we covered today. The revenue expense trap is the silent killer of small business cash flow. It happens when you keep all your money in one account and spend based on what feels available. The fix is the 3-bucket system: operating cash for survival, growth capital for intentional investment, owner's reserve for consistent personal income. Start with 1 bucket if you must. Build progressively. Add the 48-hour rule for any major unplanned expense. And remember, this is not about restriction. It is about control. When you control your cash flow, you control your decisions. When you control your decisions, you control your future. That is how you stop watching money disappear and start building something that lasts. If this video helped you see your business differently, hit the like button and subscribe for more practical finance strategies every week. Share this with a business owner who needs to hear it. Because cash flow is not just about money, it is about peace of mind. Thanks for watching. Keep your numbers strong and your business stronger.